War declared silver, $95. PAXG, $5,600 near ATH. Physical China gold, $55.60, $280 premium. While you were sleeping, missiles were already in the air. Physical gold in China, trading $280 above Western paper price. Silver lease rates spiking for 6 consecutive days. Thailand's largest gold dealer shut its doors entirely. And Bitcoin, the so-called digital gold collapsed. What the markets priced yesterday became reality today. The question is no longer if the system fractures. The question is, how much time do you have left? Before it does, welcome to IU and Ag, the channel where serious people come for serious answers. Now, before we go any further, if you've been watching us for a while, think of this subscribe button, like your morning newspaper. You wouldn't skip it for 30 years straight, so don't skip it today. One click, that's all. Your future self will thank you. And tell us in the comments, where in the world are you watching from right now? Because tonight, geography matters more than ever. On the morning of June 21st, 2025, something unusual happened. Before a single news anchor confirmed it, before a single government official made a statement. The markets already knew. Gold moved first, quietly, deliberately, like a man who sees smoke before anyone else smells fire. Silver followed, then oil, all three hard assets climbing together in perfect synchronized lockstep. To most observers, it looked like noise, random market fluctuation, background static. But to those who understood the language markets speak, it was anything but noise. It was a signal. This is how it always works. History shows that markets do not wait for headlines. They do not wait for press conferences. They do not wait for governments to tell the world what is happening. Informed capital moves first. Smart money positions quietly, while everyone else is still sleeping. And on that Friday night, while most Americans were watching television, having dinner with their families, going about their ordinary lives, somewhere in the corridors of power, a decision had already been made. U.S. and Israeli forces launched coordinated airstrikes on Tehran. Strikes targeted areas near Iran's presidential offices, near the compound of Supreme Leader Khamenei himself. President Trump addressed the nation with words that left no room for interpretation. He said American heroes may lose their lives. He said the United States would annihilate Iran's navy. These were not diplomatic warnings. This was war. Iran responded within hours. Ballistic missiles launched simultaneously toward U.S. military bases in Bahrain, Qatar, Abu Dhabi, Kuwait, and Saudi Arabia. 5 countries at the same time. Yemen's Houthis announced the resumption of Red Sea attacks. UAE, Qatar, and Kuwait shut down their airspace entirely. Major oil companies suspended shipments through the Strait of Hormuz. In a single night, the geography of global trade had changed. But here is what serious observers must understand. The gold market had already priced this reality before the first missile left the ground. That is not coincidence. That is not luck. That is the market telling anyone willing to listen exactly where the world is heading, long before the headlines confirm it. There is a particular kind of silence that falls over financial markets just before something historic happens. Not the silence of calm, the silence of held breath, the silence of informed people who already know what is coming and have already made their moves. That silence broke on the night of June 21st, 2025. The strikes did not come without warning signs. In the days before the operation, China had quietly ordered its citizens to leave Tehran. The U.S. State Department had confirmed that Iran was taking American hostages. Trump had publicly stated his dissatisfaction with ongoing Iran negotiations. Each of these signals, taken alone, meant little. Taken together, they formed a pattern that experienced observers recognized immediately. Markets recognized it too. That is why gold, silver, and oil had already begun climbing before a single aircraft crossed Iranian airspace. When the strikes finally came, they were precise and deliberate. U.S. and Israeli forces targeted central Tehran with calculated intensity. The locations chosen were not random. Strikes landed near Iran's presidential offices, near the compound of Supreme Leader Khamenei. These were not warning shots. These were messages written in fire, delivered to the highest levels of Iranian power. Trump's language removed any remaining ambiguity. He told the American public to expect casualties. He described plans to annihilate Iran's navy and obliterate its missile production infrastructure entirely. He then took a step that no U.S. president had taken so directly in modern memory. He publicly called on the Iranian people to overthrow their own government the moment strikes concluded. Iran's response came fast and broad. Ballistic missiles were launched toward U.S. military installations across 5 separate countries simultaneously. Bahrain, Qatar, Abu Dhabi, Kuwait, and Saudi Arabia all faced incoming Iranian missiles within the same operational window. Iran then launched a separate retaliatory wave directly targeting Israel. Israel responded by stating its objective with complete clarity. The goal was not de-escalation. The goal was not negotiation. Israel stated openly that it intended to end the Ayatollah's regime entirely. UAE, Qatar, and Kuwait shut down their airspace. Several major oil companies suspended Hormuz shipments immediately. A senior U.S. official confirmed that airstrikes would continue not for hours, but for days and potentially weeks. This was no longer a geopolitical tension. This was active, multi-theater, declared warfare with explicit regime change, objectives stated publicly by both sides. The world had crossed a threshold from which there is rarely an easy return. There is an old saying among serious investors that price never lies. Politicians lie, analysts lie, press releases lie. But when a buyer in Shanghai opens his wallet and pays $282 more per ounce than the official Western price for the exact same metal, that is not an opinion. That is not speculation. That is reality denominated in hard currency, and it demands serious attention from anyone who considers themselves financially literate. On the night the strikes began, 2 separate gold markets told the same story from opposite sides of the world. PAXG, a cryptocurrency token backed 1-to-1 by physical gold stored in London vaults, spiked to $5,600 per ounce in a single overnight session. This was a 6% move in hours. It brought PAXG within $50 of its all-time high of $5,650 before a partial pullback settled prices around $5,400. This was not speculative trading driven by retail excitement. PAXG moves when people who understand physical gold want exposure immediately, when they cannot wait for Monday morning futures markets to open, when they need a position right now because they understand what the news means before most people have read the headlines. Simultaneously, in China's spot gold market, prices were quoted at 1,226 yuan per gram. When converted to dollars per ounce, that number becomes 5,560. Western spot gold at the same moment was trading at $5,278. The arithmetic is simple and the conclusion is unavoidable. Buyers in the world's largest physical gold market were willingly paying $280 more per ounce than Western paper markets suggested gold was worth. That premium is not a rounding error. That premium is a verdict. Thailand's Ha Sang Hung, one of Southeast Asia's most established gold dealers, halted trading entirely. The official reason given was excessive price volatility. But sophisticated observers understood the real message. When a dealer with decades of experience managing volatile markets decides the situation has moved beyond manageable pricing risk, it means physical and paper gold are no longer operating in the same universe. Most Western portfolios allocate between 1 and 2% to gold, 1 to 2%, while Asia pays $282 premiums during active warfare, while tokenized physical gold nearly touches all-time highs overnight. While major dealers suspend operations because they cannot reconcile paper price with physical reality, the market is not sending a subtle signal anymore. It is broadcasting at full volume to anyone willing to listen. Silver rarely announces itself loudly. It does not make dramatic speeches. It does not hold press conferences. It communicates through data points that most casual observers scroll past without a second glance. Lease rates, open interest figures, registered versus eligible inventory movements. To the untrained eye, these numbers look like administrative footnotes. To those who understand what they represent, they read like a confession from a system under extraordinary and growing strain. The stress signals in silver did not begin the night the missiles flew. They had been building quietly for weeks, accumulating like pressure behind a sealed door, visible to anyone who chose to look carefully at the structure rather than the surface. COMEX open interest on silver futures collapsed from 162,000 contracts approximately 1 month ago to 118,000 contracts at the time of the strikes. That is a 27% reduction in paper market participation. Under normal circumstances, falling open interest alongside rising prices would suggest short covering, a temporary technical move with limited long-term significance. But these were not normal circumstances. Silver's price had climbed from the low 80s to $95 during the same period that open interest was collapsing. That combination tells a specific and uncomfortable story. The paper market was shrinking precisely as physical demand was intensifying. Lease rates told the same story from a different angle. Silver lease rates climbed for 6 consecutive days before the war news broke. They reached 1.6%, a level that signals meaningful stress in the lending market for physical metal. When institutions need to borrow physical silver, and the cost of that borrowing rises 6 days in a row, it means available supply for immediate delivery is tightening in ways that futures prices have not yet fully acknowledged. COMEX registered silver, the metal actually available for delivery against futures contracts, saw 2.3 million ounces added, while eligible silver fell by 2.6 million ounces simultaneously. Eligible metal is silver sitting in approved vaults, but not yet committed for delivery. When eligible falls while registered rises, it means owners are converting uncommitted metal into committed positions, suggesting they anticipate demand they intend to meet on their own terms rather than the market's. In Shenzhen, the largest recycling company was offering $15 per ounce above spot for 99.99% pure silver. Shanghai spot quoted $185 per ounce, while Western spot sat at $93, a $12 out of dollars premium between physical East and paper West on silver during active Middle Eastern warfare, with lease rates spiking and open interest collapsing simultaneously. The signals were never hidden. They were simply waiting for someone serious enough to read them. For years, a compelling argument circulated through financial media, investment conferences, and late-night internet forums. The argument was elegant in its simplicity. Bitcoin, it was said, was digital gold, a modern store of value engineered for the 21st century, scarce by design, decentralized by architecture, immune to the political decisions of central bankers, and immune to the geographical vulnerabilities of physical metal sitting in vaults. Millions of serious, intelligent people accepted this argument. Billions of dollars moved into cryptocurrency markets partly on the foundation of this single premise. On the night of June 21st, 2025, that premise was tested under real conditions for perhaps the most definitive time in its history. Bitcoin failed the test completely. When U.S. and Israeli strikes hit Tehran and Iran launched retaliatory ballistic missiles toward 5 countries simultaneously, the crypto market did not behave like a safe haven. It behaved like a risk asset caught in a thunderstorm. Bitcoin plunged to $63,000 within hours of the strikes becoming public knowledge. Over $100 million in leveraged long positions were liquidated in 15 minutes, not gradually, not in an orderly repricing. In 15 minutes, leveraged crypto traders watching their positions collapse in real time while missiles were still in the air over the Middle East. Physical gold told a completely different story during those same 15 minutes. PAXG touched $5,600 in Asia. China's spot market quoted $5,106. The $282 premium over Western paper prices held and widened. Thailand's dealers suspended operations because physical demand exceeded their capacity to manage it. The divergence between what happened to Bitcoin and what happened to physical gold during an actual declared war was not subtle. It was absolute, and it was immediate. This divergence matters beyond the single data point of one overnight session. It matters because it answers a question that portfolio managers, institutional allocators, and serious private investors have been debating for nearly a decade. When genuine systemic fear enters the market, when actual warfare breaks out across multiple theaters simultaneously, when ordinary people in multiple countries suddenly need to preserve wealth against genuine uncertainty, where does capital actually go? It does not go to blockchain addresses. It does not go to digital tokens. It does not go to assets that require electricity, internet connectivity, and functioning exchange infrastructure to access under pressure. It goes to metal. It always has. And on the night the world changed, it did again. The market rendered its verdict without sentiment and without hesitation. There's a narrow strip of water between the Gulf of Oman and the Persian Gulf that most people could not locate on a map without assistance. It is approximately 21 miles wide at its narrowest navigable point, unremarkable in appearance, extraordinary in consequence. Through this single choke point flows approximately 20% of the world's entire oil supply every single day. Tankers carrying crude from Saudi Arabia, Iraq, Kuwait, UAE, and Iran pass through this corridor in a continuous procession that the global economy has quietly built itself around over the course of decades. It is called the Strait of Hormuz, and on the night of June 21st, 2025, several major oil companies decided they were no longer willing to send their vessels through it. That decision did not happen in a vacuum. It happened because experienced logistics professionals who move physical commodities for a living looked at the operational reality unfolding around them and concluded that the risk calculation had fundamentally changed. These are not emotional people. They are not reacting to headlines or social media commentary. They are calculating insurance costs, crew safety exposure, vessel vulnerability, and the probability of their assets becoming collateral damage in an active multi-theater military conflict. When those professionals simultaneously suspend shipments, the message they are sending to the broader market is precise and unambiguous. The supply chain that the modern world depends upon has just become unreliable. UAE, Qatar, and Kuwait closing their airspace compounded the disruption immediately. Air freight corridors that businesses across Europe, Asia, and North America depend upon for time-sensitive cargo were suddenly unavailable. Pharmaceutical shipments, electronic components, perishable goods, financial documents. The modern global supply chain does not distinguish between wartime and peacetime. It simply moves until it cannot, and then everything that depended upon its movement stops moving too. Yemen's Houthis announcing the resumption of Red Sea attacks added a second choke point to the equation simultaneously. The Bab el Mandeb Strait, through which Red Sea shipping must pass to reach the Suez Canal, had already experienced significant disruption in previous Houthi campaigns. Shipping companies that had only recently begun cautiously returning to Red Sea routes were now facing the prospect of both southern and eastern maritime corridors becoming operationally compromised at the same time. 2 choke points, 1 conflict. Every container ship operator, every oil tanker company, and every supply chain manager on Earth recalculating their exposure before Monday morning markets opened. The geography of global trade was being redrawn in real time. In the study of economic history, there are moments that analysts later describe as inflection points. Moments where multiple independent forces, each significant on their own, converge within a single compressed time frame and produce consequences that none of them would have generated in isolation. These moments are rare. They are difficult to recognize in real time precisely because the human mind tends to process events sequentially, one at a time, rather than understanding the compounding effect of several powerful forces activating together at the exact same moment. The night of June 21st, 2025 was one of those moments. The first accelerator was geopolitical chaos. War between the United States, Israel, and Iran did not simply create fear in financial markets. It created a specific and rational demand for assets that hold value independent of any government's promise or any central bank's decision. When missiles cross borders and strike military installations across 5 countries simultaneously, the ancient human instinct to convert paper promises into tangible reality does not require sophisticated financial education to activate. It activates automatically. It activated in Asia overnight with $282 premiums and suspended trading floors as evidence. The second accelerator was dollar weaponization. This force had been building long before the first strike was launched. Years of watching the United States freeze foreign reserves, impose sanctions, and exclude nations from dollar-denominated systems had already driven central banks across the developing world into quiet but persistent gold accumulation programs. The war did not create this trend. It accelerated it with sudden and dramatic force. Every central bank watching events unfold understood immediately that dollar dependency had just become a more visible and more urgent vulnerability. The third accelerator was supply disruption. Hormuz closing, Red Sea attacks resuming, and airspace shutting across 3 Gulf states did not merely threaten oil prices. They threatened the physical movement of every commodity that travels through those corridors. Silver has significant industrial demand. Gold has significant jewelry and electronics demand concentrated in Asian markets. When the shipping lanes, connecting producers to consumers, become militarily compromised, physical scarcity becomes a realistic near-term possibility rather than a theoretical long-term concern. The fourth accelerator was central bank accumulation, which had already been running at historically elevated levels for 18 consecutive months before the conflict began. Central banks do not reverse course quickly. Their buying programs operate on institutional timelines measured in quarters and years. The war did not interrupt their accumulation. It validated it publicly and completely in a single overnight session. 4 accelerators, 1 night. No coincidence. History does not reward the loudest voices in the room. It rewards the most prepared ones. The investors, strategists, and decision makers who navigated the 2008 financial crisis successfully were not the ones who reacted fastest to the Lehman Brothers collapse headline. They were the ones who had spent months reading structural signals, understanding what the data was communicating beneath the surface noise, and positioning themselves accordingly before the moment of maximum public panic arrived. By the time the headlines confirmed what the market structure had been saying for months, their preparation was already complete. The 48 hours following the June 21st strikes represent exactly that kind of window for serious observers today. The first variable demanding close attention is COMEX behavior when futures markets opened Sunday evening. PAXG traded at $5,600 overnight. China's physical market quoted $5,560. Hyperlliquid showed gold at $5,414 and silver at $95, while Western exchanges were closed. These are not theoretical projections. These are actual prices discovered in functioning markets while COMEX sat dormant. When futures open, the gap between where Western paper markets closed Friday and where physical Asian markets traded overnight will need to be reconciled. The size of that gap and whether it holds or gets aggressively compressed within the first hours of trading will tell serious observers everything they need to know about whether institutional coordination is overriding physical price discovery once again. The second variable is Shanghai premium movement on both gold and silver. If China's $280 gold premium and $12 silver premium widen further when Asian markets reopen for the new week, it signals that physical demand is accelerating beyond what any short-term futures manipulation can sustainably suppress. If premiums compress significantly, it suggests either de-escalation is being priced in or institutional intervention has temporarily reasserted paper market dominance over physical reality. The third variable is strike duration and Iranian response escalation. A U.S. official confirmed operations would continue for days and potentially weeks. If strike intensity increases, if Iran expands its retaliation beyond the initial 5-country barrage, or if Hormuz closure moves from voluntary corporate suspension to active military enforcement, the commodity supply disruption scenario transitions from serious concern to confirmed crisis. The fourth variable is COMEX registered silver inventory. If registered levels continue declining while lease rates remain elevated and open interest stays compressed, the paper silver market's capacity to absorb physical demand through future settlement faces a structural test. It may not pass quietly. Serious times demand serious attention. The window is open. The signals are visible. The only question that remains is who is actually watching.